Look at the paper cash in your wallet or the numbers on your banking app. What actually makes them valuable? If you think about it, a $20 bill is just a piece of paper. It has no real value on its own. You can't eat it, you can't build a house out of it, and it doesn't keep you warm. So why will a stranger hand over a delicious meal, a pair of shoes, or even a laptop just because you gave them a few pieces of this paper? The answer is simple: trust. In economics, money isn't defined by what it's made of. Money is defined entirely by what it does. Money is simply anything that a group of people all agree to use to buy things and pay off debts. If everyone tomorrow agreed that green sticky notes could buy cars, then green sticky notes would officially be money. But how did we get to a point where we trust useless paper and digital digits? Let's break down the facts. Throughout history, humanity has used 4 different types of money. The first type is commodity money. This is money that has real value on its own. In the ancient world, people traded using gold, silver, blocks of salt, or even seashells. If the economy crashed, you still owned an actual piece of precious metal. The second type is representative money. As you can imagine, carrying heavy bags of gold coins was annoying and dangerous. So, early banks started locking people's gold inside secure vaults. In return, they gave the owner a paper receipt. People quickly realized they didn't need to go fetch the gold every time they wanted to buy something. They could just trade the paper receipts instead. The paper represented real gold in a vault. The third type is what we use today: fiat money. In 1971, the world changed forever when governments completely stopped backing paper cash with gold. Today, your cash is backed by absolutely nothing. It only works because the government says it's legal currency, and because we all agree to trust it. And finally, the fourth type is digital money. This is the money that only exists as numbers on a computer screen. When you swipe a card or get a direct deposit, no physical cash changes hands. It's just banks updating a giant, global digital checklist. We didn't just wake up with credit cards and banking apps. Money evolved to fix a massive problem called the barter system. Before money, if you were a caveman who had a spare cow but desperately needed wheat, you had to wander around until you found a farmer who had wheat and actively wanted a cow. If that farmer wanted chickens instead, you were completely out of luck. In economics, this headache is called the coincidence of wants. To fix this friction, humans invented standard metal coins so everyone could trade instantly. When the coins got too heavy, we created paper receipts. And today, paper is disappearing as money evolves into pure digital data. For anything to successfully work as money in an economy, it has to do 3 basic jobs. First, it must be a medium of exchange. This just means it has to be widely accepted so you don't have to awkwardly trade cows for wheat. Second, it must be a unit of account. Think of this as a financial yardstick. It allows us to put a fair price tag on things, letting you know that a car is worth more than a candy bar. Third, it must be a store of value. If you put a $100 bill under your mattress today, it will still be a $100 bill when you pull it out next year. It won't rot like fruit or die like livestock. It saves your hard work for the future. Because our modern money is just paper and digital numbers, someone has to control how much of it exists. If you print too much, it becomes worthless. If you print too little, the economy freezes. The manager in charge of this is the central bank. They treat the economy like a room, and they use the money supply as a thermostat to turn the temperature up or down. They do this primarily using 2 tools. Tool number 1 is interest rates. When the economy is overheating and prices are rising way too fast, which we call inflation, the central bank raises interest rates. Suddenly, credit cards, car loans, and house mortgages become incredibly expensive. Because borrowing costs so much, regular people and big businesses stop spending money. This cools the economy down and forces prices to stop rising. On the flip side, if the economy is crashing and people are losing their jobs, the central bank does the exact opposite. They lower interest rates. Now, borrowing money is practically free. Businesses take out cheap loans to hire workers, consumers start spending again, and the economy speeds up. Tool number 2 is open market operations. This is a fancy term for printing or hiding money. If the economy needs a boost, the central bank buys up financial assets from regular banks, flooding the system with fresh cash so those banks can loan it out to you. If there is too much money floating around, they sell those assets back to the banks, taking that extra cash out of circulation to dry up the wild spending. Money is the ultimate tool. It evolved from swapping cows to clicking buttons, and its entire power relies on our shared trust. But as we've seen, the amount of money allowed into your daily life is heavily manipulated behind the scenes by central authorities trying to keep the global machine balanced. If you want to build a smarter, fact-based understanding of how money, business, and the global markets actually work, without the confusing fluff, make sure to hit the subscribe button. Thanks for watching Market Tales, and we'll see you in the next breakdown.